trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good morning and happy Thursday to all of our market rebels once again. And we're going to do it again, Stu. We're on early. We have to record. We have a special promo at 4 p.m., but at least it's the same day. It is Thursday morning. And I think we just had a couple of economic numbers coming out. Didn't we have like PPI
Market's down a little bit, about a half of 1%. But
Okay.
it's early. We'll see how it
It's
shakes
early.
out.
That can change by 9:30 exactly, but for all of the people in our Q&As, we'll definitely be taking a look at that, so that'll be fun to watch. But today we've got a very cool, I think they're all very cool. That's what we try to do, is to show you super helpful ideas, tips, strategies that can help you to make better decisions by understanding options and markets better. But today we're going to enter into the realm more of the behavioral finance, the psychology. And this is one of my favorite topics because I know you and I talk about this all the time. Greg talks about it. I'm not going to give away what the answers right now, but it's one that we all talk about. But we think that a lot of people out there don't know it. And so we think it's going to be something that'll hit home with a lot of people. So let's start with our Chalk Talk question. And before I even show it, I'm going to say, admittedly, it is very vague, but we want you to just think. So here's the question. You own 100 shares of ABC stock, currently trading for 100, and sometime later it drops to 92. What would you do? Now, it's not necessarily one thing, but what we want you to do is to think of, or if you have a piece of paper in front of you, jot it down. What are maybe a list of things that you would do? Would you sell it? Would you go buy puts? Just think of some of the things that you would at least be thinking about in this situation. Okay, and I can already tell you, I know how most people would answer, but we want you to jot that down, and then we're going to talk about a very interesting psychological phenomenon. Ready for this, Stu? I know you know this one, called the goalkeeper bias.
Yeah, this is really cool.
Yeah, what are we talking about sports here when it comes to options? Well, there's a very good reason. This is a very real-world study, and it has a lot to do with trading psychology. So let's go find out more about the goalkeeper bias and what it has to do with options trading. And before we do, Stu, as always, got to remind everybody, marketrebellion.com/get started for more topics just like this, videos, articles, and things that are really essential ideas and concepts to help you make better decisions. So this one comes to us today. Normally we're in the Journal of Finance or something like that, but look at this. Journal of Economic Psychology. Who'd have even thought there was such a journal, but there is. And back in 2008, two Israeli researchers analyzed 286 penalty kicks in soccer or football, depending on where you're from. But 286 penalty kicks. And they had this theory, and it turned out to be right. I think this is just very interesting that they even thought to look here. And this falls into, again, behavioral finance, behavioral economics, which It's been around for a while. You can actually get a degree in it at many universities. But Kahneman and Tversky are really considered at least two of the founding fathers of behavioral economics. And again, it's the psychology of investing decisions and how or the way that our brains interpret information, or because of our risk aversion, our tremendous fear of losing money, makes us usually take wrong decisions. And so there's a lot of different studies in this, and I believe it was in 2002 that Daniel Kahneman won the Nobel Prize. First time, and I still believe to this day, only time that a psychologist has won a Nobel Prize for economics. But they have proven that it is super, super critical. So here's the setup, Stu. They had a feeling this is what they were going to find, and they said, okay, well, let's look at penalty kicks in soccer, where you just got a kicker and you're facing, you're squaring off with the goalie. Now, you would think that before you do any analysis, that 1/3 of the kicks should be over here to the left or to the goalie's right. A third should be in the center, and a third should be over here to the right. That's assuming we're going to divide this up into thirds. And that's reasonable because by the time the goalie takes even a step, sticks his arms out, they can cover usually in thirds. Now let's back up for a second. Why should they expect this, Stu? Why do you think we should expect 1/3 in each of these?
Well, I mean, you got to kind of figure it's got a equal chance of going wherever it goes. So why not?
Why not? Plus, these guys are very accurate at doing it. I was also thinking that uh, if it were heavily biased, let's say that it were 70, or let's make an extreme example, 100% of the time they kick here.
Hmm.
Well, now what happens? Well, now the goalie's just going to stand there. So it's like in the markets will eventually adjust. This would be almost like an arbitrage. So then
Becomes a
people say, all
no.
right,
So
well,
yeah.
yeah, they'll say, okay, well, this is stupid. Maybe we should always start going over here. Then the goalies adjust. So the best thing to do for the kicker is to keep the goalie completely guessing. And the way that you do that is to have equal shots. If the goalie says, I have no idea, it's 1/3 chance for all of them, now we have a maximum case of uncertainty. We really can't pick. So that's what these researchers thought that they would find. And again, I think this was such an interesting, brilliant thing to even look at. But what do you suppose they found?
That wasn't the case.
That's exactly right. That wasn't their case. Now, I'm going to challenge you to this. I think you might know, but where do you think was the place that the goalies least likely were to be?
Center.
Very good. That's exactly right. What they found is that 6% of the time, think about that. We would expect 33, and 6% of the time they stayed. And the other two were balanced. Again, keeping people guessing, 47% would be out in the wings. But then the question is, why did they stay? Or why didn't they stay? Why did they tend to move? And again, this was kind of what they had a feeling that they were going to find. I doubt they were going to even expected it to be this extreme. I
Let
even
me just
find this
let
super
me just say
fascinating.
here that I didn't know that Bill was going to ask me that question, but my my trading
Yep.
training,
Yep.
my background of what I do and what I've learned not to do, um, told me what that answer should be.
Yeah. Yeah.
Yeah,
And
it's
again, that's
really,
why I
really
wanted to share it with people. I find this to be one of the more interesting psychological studies, at least in terms of finance, ever. And I think it's got super applications. And even recently, for all the tariff tantrums, but I mean, pick your moment in time. Go back to COVID, 2007, 2008. We've had tons of them. You were actually on the floor in the crash of 87. That's still the king
it
of
was.
kings. That was a doozy.
That was a doozy. That was a
What was
doozy.
it, down 20? What were we down 20?
22.7%, I believe.
Not that anybody's counting. Wow. I mean, in a day, think about that. A lot of times we won't do that in a 2-year period.
Yeah, 20% a day. It's big.
That's, I mean, people had to just be scratching their heads going, what's going on? So
Yeah.
back to the story here. Why do you suppose that we see such a low number in the center?
And think of this, people, in with respect to like what Bill asked in the very beginning. You know, what would you do?
Yep. That's where it's
And
all heading.
yeah, go ahead.
Yep, very good. So let's ask the question, why stand still? Well, if a goalie stands still and does nothing, then he appears indecisive. And who wants to look like they're indecisive, especially when you're
Right.
making big money? But by choosing a direction, he's at least taking action. And it turns out that people just feel better about bad outcomes if they at least did something, if they at least chose some type of action. Well, yeah, I went and I bought those puts and the market shot up, but you know what? At least I hedged myself.
At least I did something.
At least I did
Right.
something.
Yeah.
You know, I sold it and I locked in the gains, but who cares that it shot up 20% in the next week? At least I took some action and I did something. They always have this reason for thinking that they have to take some kind of action.
I'll get them next time.
I'll
Oh,
get
there's
them
another one.
exactly. I'll wait.
Yeah.
I'll wait for the next trade. And then my favorite response is, well, why didn't you do it on the last trade? If you think you got a better shot on the next one, why do we keep hearing the same excuse? So this is really the big thing that they were thinking, that the goalies were probably, even though we should see 1/3, probably going to want to do something. They start in the center and are going to just have to guess, right? These kicks come super quick. You don't have time to say, let me see where it's going and then move, right? You have kind of like Wayne Gretzky said, you have to skate to where you think the puck will be,
Mm.
not to where it is. Right. And it's the same thing for the goalies here. You can't wait to say, oh, the ball's over there, let me go. The
That's too
same
late.
thing in trading. You can't say, oh, the stock's up 20%, let me go.
Yeah, let me
So
buy it 20 points ago.
yeah,
Thank you.
exactly. So
Good
it's
job.
again, it's this feeling that they have to take some kind of action. Now, one thing that we hear a lot about, and we're not necessarily bashing this, Stu and I have our own opinions. We did a coach's corner on that with time dependent versus path dependent and why we don't use stops with options. But let's address this for most people out there. Will stop orders work? We're saying, okay, I want to at least do something. Let me make sure I don't take too big of a loss. Well, what you're doing here is you have to get out. At least that's their mentality. I'll get out with a stop order, and then I can always get back in at a more favorable price. The problem with that is that you must not only get out in time, but you have to get back in order for that strategy to work. We were just talking about this the other day in our Q&A, that you have to be right twice. And every time you use the word and,
Yeah.
statistically speaking,
Yeah.
it's knocking
I'm,
down those probabilities. So it's
I'm
not just
used
about
to that.
getting out, it's getting out and back in. You have to be right twice, because what happens psychologically? Stock's at 100, it drops. Okay, I got triggered out at 95 on my stop, and then it's going to 96 or 97. I don't quite trust it. 98, nah, it's going to come back. Then it jumps to 101 or 102. Oh, I don't want to buy it now. I'll wait. And then it just keeps climbing, and you never get back in. Everybody thinks that they will, but the market doesn't always give you that chance. So right here, think about this. If you have a 70% chance of being right on both counts, getting out at the right time and back in, which I assure you nobody does, you've got you just multiply those together, you've got a 49% chance of being right on both occasions. Well, that's not even as good as a coin flip, right? You might as well just flip a coin and be better off. You're going, why do you think that you can just time it to get out and back in? Now, sure, sometimes it'll work, but don't mistake luck and random movements in the market for being genius. Of course, sometimes they're going to work, but is it going to be a good long run strategy? So here's a perfect case in point. Let's go all the way back. We were talking about COVID earlier. Here, everybody remembers that. So take a look down here, Stu. I can't believe the SPY was down that low. We were at 276, let's say in the halfway point in this precipitous fall right here. The VIX was at 55. And a lot of people think, oh, let me get out. Okay, well, maybe you got out somewhere in that middle. But, the SPY went down to 218 from there. That's down 58 points. And think about how, percentage-wise, that's a big drop. But look what happened. This was just shot yesterday. Look at the far right side of the screen. The SPY's at 646. That's up 428 points.
Everybody's saying, well, I would have got back in
I
somewhere.
would have
Yeah,
gotten back in, and you might have, yeah, but
maybe.
you probably would have done it up here.
maybe.
Prob-
Yeah,
or you wait so long, you get in here, and then it falls again. Ah, these markets just kill me every time, and you get
and
out.
then you're
Now
out
you got an
again.
even bigger hole to dig out of.
Yeah, you do it again.
Whereas if you had just held and said, look, the zigs and the zags don't matter. It's the current that we're after, right? It's the long-term current that we're after. Now, can we take some strategies that will limit us? We're going to talk about that in a minute. Are there some things we can do to mitigate some of the unwanted risks? Yes. But if you try to completely hedge yourself, you're going to miss that. And in fact, that's what I tell traders all the time. That's the easiest problem to solve. What do?
You just buy a T-bill.
Buy T-bills. There you go. If you want to completely hedge your hedges, I'm going to buy puts, but I'm going to buy two puts. I'm going to doubly hedge. I don't want to take any risk. That's the easiest problem in the world to solve. But you can't get these returns from 276 to 646 and be completely hedged. It just doesn't work.
And Bill's using this. You may be thinking Bill's using this as an example, and he's kind of cherry picking an example. Um, when you think about what this spider really is, a big diversified 500 stock index.
Right.
This concept just gets exacerbated when you're talking about a single stock.
Oh
The
yeah,
volatility on a single stock, most of the time is going to far outweigh the volatility on a big index like the spider. And
absolutely.
there's a lot more chances of you getting blown out of the water and kind of missing, what you're in it for, which is to make better than the T-bill.
That's
Which
right.
really kind of leads you right back down to the path of figuring out strategies and knowing how options really work to try and hedge yourself up front, not after it already happened.
Right. So you can see where people think, oh, well, I need to get out and back in, or I need to buy puts at 55% volatility. No, thank you. But people do. And again, it's back to that goalkeeper bias. I need to do something. I mean, look, we were in this nice little uptrend, and then bang, straight off a cliff. I think that was like March 5th or so, early March. Started the news was coming out back in here, but we really started to go off a cliff on about, I think, roughly around the 5th, and it was, I mean, straight down.
Kind of looks like the tariff tantrum, doesn't it? A little
It's
bit.
I mean, that really shows you how impressive that
These
was
things
because
happen. They always come around.
I know
It's and
the
again and again and again. It's just going to
very
happen.
similar drop, very similar recovery. Um, but again, the point is that people think through this, and we heard lots of it in Q&A. What should I do?
Yeah,
And a lot of times we said, well, one choice is to do nothing and just write it out. I
that
talked
is
about
good.
that even on Cocktail Hour. I said it is most likely going to be a V bottom. It never even affected the credit markets. We were long ways away from having any kind of, not saying that it couldn't have happened, but we weren't there yet to where you need to be super concerned back here. And what I did is I took buys of shares on every single green candle on the left and every single one on the right up until we got up to this point again, just to add to what I was previously doing. I took every single one of them. Now, did I know it was going to be whatever that was, 8 or 9 months? Had no idea. Could have been 3 years. I was prepared to just keep buying through there. That's part of the goal, part of the, uh, of having a goal and a strategy, but sticking with your discipline. So at any rate, the point is that when you're in this stuff or in this, and look at how many of these there are, Stu. I mean, if you zoom in now, right now, this looks like nothing because we've got such a big amount of time across here. But if you zoom in on that, that's a big drop right there.
Hmm.
That's another big drop. There's another one, another one, another. I mean, they happen every couple of, look at that. I mean, from there to there, little rally, bang, back there. Look at all of these little downturns. They're everywhere. And if you think that you're going to avoid those, especially over the long term, and that you can get out here and I'll get back in maybe on this side, and then I'll get out maybe here and I'll get back in, it's just not going to happen. And you will absolutely have a lot of those where you're going to, get out here, and it's going to be back up here before you even know what happened. So the part of what we're trying to show is that when you are in these moments in time that happen all the time, sometimes your best course of action is to stay put. Just like the goalie, sometimes you should be doing for in his perspective, staying one third of the time in the center.
Yeah, it comes really what it comes down to, in my opinion, here is that you, you gotta be where you want to be in the beginning,
That's right.
right? You gotta plan ahead. You gotta
Yep.
plan for these kind of things, and that's like I said before. That's where that strategy comes in. Whether it's a ratio or a vertical or
Yep.
some sort of diagonal or maybe just
Scaling in, which we talk about all the time. If you pile in, if you go, hey, I know this is the bottom right here, let me pile in everything that I've got on margin, and then you go off of this, you want to
you're
talk
cooked.
about panic?
Yeah, you're cooked. And it's not even
Or the
your
broker's
call.
going to
The broker's
force
going
you.
to make that call for you.
The broker
Um,
might make that call for you.
and,
And
even
now,
even if it's as simple as maybe a stock replacement option,
yep,
that in and of itself is a hedge, and you
huge
have.
hedge. We're going to talk. Yep, I've got a slide for that. It's a
Oh, do you?
huge hedge.
Okay, so I mean, like you have to ask yourself, is it enough? You have to get away from the percentages, and you have to look at the dollars, and you got to say, I have a hedge. Is it enough of a hedge? And if the
Is it enough?
answer is yes, just leave it alone. What do you care?
Exactly.
What's the
Exactly.
difference?
That's exactly what the point is sometimes. And because there's these huge debates about, oh, you can't lose 100% on an option. That's just like, uh,
Such
the ultimate
nonsense.
sin. You're going, you can't do that. Well, that's not true. The
No.
option is a hedge
Yeah.
because now what you're doing is arguing over how much is okay to lose. If Stu buys stock at 100 and he says, I want to get out at 95, and I say I'm willing to get out at 90, which one of us is right? You see, those are more just judgment calls. He might get out at 95, it falls down to 93, I'm still in, and then it ramps up and trading for 200 down the road.
Yeah,
So
I
now
mean,
who is right?
you could spin all kinds of
You can
stories
spin
on this
all
whole
kinds of things.
percentage thing.
So yeah, that's
Five
really what you're
percent. Bill's
arguing about.
Bill's talking about 95, 5%, 90, 10% on the stock. Maybe that's acceptable, that $10. But if you bought a $10 option and it went to five and you lost five and now it's 50%, or you
Right.
lost six and now it's 60%, all of a sudden now it becomes completely unacceptable.
Or
And
10 and you lose 100%. That's what
and 10
everybody's
or you lose
fearful.
100%. It's just, and you didn't have,
It's
but you had the downside hedge at
Yep, and
$10.
you had a downside hedge defined.
Where in the stock you didn't have the downside hedge, you just
Right.
have $10, and then you have whatever comes after it.
Right.
So these are steps 2, 3, 4, 5, 6, 7 down the road that people tend to not really think about up front in the beginning, to try and put themselves in a place where they can take advantage of a
That's right.
long-term upward bias, or
That's right.
a 3-month outlook on a particular issue that they're looking at.
Yeah.
Um, when they use these kind of maneuvers, you're just taking away the effect of time being able to help you out. Um,
And that's your biggest asset in this game.
and that is yeah, that's a
As
big
we're
one.
seeing right here, look at all those landmines in there. I mean, they're everywhere. In fact, there's probably more little down dips than there are little up. I mean, look at that. And the
Mhm.
sizes of these, they happen all the time. That's just part of a random walk. But
And
there
Bill and
is
I
a long-term upward
we aren't
bias.
we aren't sitting here advocating to just sit in your hands and do absolutely nothing
No, we're
100%.
not. We're just
We
saying
are
that that is
advocating
a choice at times that most people overlook.
we are advocating the idea to understand what strategies are and how options can perform for you,
Correct.
and will they meet the goals that you're trying to reach for, relative to something else like just buying the equity.
Right.
And how will it play out as the world starts to play out, in with the
Right.
stock moving up and down, and time and implied volatility, even interest rate moves can affect these things. That's what we're really talking about here. Just to know the product and understand how it can help you, and will it help you to meet your
Yeah.
goals, without getting without these dips getting in the way.
Yeah. What is the expression that Greg uses? It's something like that in the trading pit. Not trading is a decision, or not. Um,
Yeah, I don't know how he
it's
says it.
something like that, but they have the
Not
same
doing
thing.
something is a decision to do something. Yeah, I
Yeah,
don't
it's
know
they have
that.
some kind of a catchy phrase like that, but it's the same thing here. And what we're
Yeah.
trying to show is that every professional trader knows this, and yet most other people who are, especially if you're new to investing or trading, never want to do nothing. It's never on their list. And again, as Stu said, we're not saying that the best thing is to always do nothing. We're saying at least include that as your decision, or at least in your list of things to do,
And
or
this concept
possibilities.
plays out in lots of different areas. Here's another
Oh
example,
yeah,
real quickly. We were talking about this yesterday, I think, somewhere we were, Bill, or maybe it was Tuesday in one of the Q&As, where you do a strategy, and maybe you do a credit spread and you sell it for $2, and now it's trading at $1. And I just kind of picked that because general thing is, well, when it's halfway done, I'll kind of take it off.
I'll take it off.
Well, maybe at $1, it's a better do than it was at $2.
Yeah,
Right,
the
you're
stock
actually
could
taking
be
off the
way up.
better do where you could have, and look, that'll happen sometimes and won't happen sometimes, but
Right.
it's a case by case thing. But just to have like these blanket, well, it's this percent, so I've got to do.
You're
It's
not taking into
just
account
total
the new
nonsense.
information that has hit the market when you do that. If I say I'm going to do a credit spread for 2 and I'm going to buy it back at 1, that's my goal. Well, why should that be your goal? That's an arbitrary point. When that, the Stu is saying, when that spread becomes 1, maybe it's a screaming sell at that point, and you might as well just let it ride. Maybe it's a much better thing
It could be,
to.
it's that what Bill likes to refer to as a low hanging fruit, or maybe you're using it at some metric against time. Like
Yeah,
maybe if you have 2 weeks and 3 days goes by, or 4 days goes by, and you're at halfway, you're ahead of that time curve. Maybe that's a good idea to take it off. In fact, it probably would be a good idea to take it off. You're way ahead of that time curve, but again, it's a case by case. Uh, you know, to it's a case by case example to just understand what it is, what you have, where you think these options could be going,
yeah.
while examining, the world around you.
Every day is a trading day at mark to market, not the price that you paid or where you sold it.
No, no, not
Based
at
on the
all.
new information, do I hold or do I exit? And yet, and most people don't. They have these arbitrary points about where they're going to get in and get out. So let's look at an example here. And before we do, quick reminder, marketrebellion.com/get started. So when should you exit? Um, how much am I willing to lose? And is there a price that will convince you that your initial outlook was wrong? This is really the one that I think that's kind of what we were just talking about. Is there something that says that my outlook was wrong? I buy a stock at 100. I think it's going to be, look, think back to Nvidia when it went from 100 to 700, and I think it's going to absolutely be on fire. But it goes from 100 to 91st. Does that mean I'm wrong? There's no news, there's no information. It's probably just random noise, other things. I might say, well, there's nothing that proves to me that I'm wrong. Let me continue to hold. In other words, let me do nothing.
I'm thinking about my friend who constantly tells me about his Apple story way back in the day when it was
Oh,
a pretty
lots of
young
those.
company. When he bought it at 32 and watched it go to like 23 or 24,
Yep.
25. And he bailed on it, and now he just laughs at it. It's like, really? I mean,
Yeah. Right.
it's
Couldn't handle exactly. So again, some people will say this: how much am I willing to lose? And we're going to talk about why that's important for stock replacement. But this, to me, is really what should be your dividing line. Um, is there a price that will convince you that you're just wrong?
or
And
an event,
or
or
an event that has come out.
I
Yeah,
but
uh,
the thing about that is the price will be reflected in
the
the
price should
event.
be
So they're
reflected.
they're
Yeah,
kind of
yeah.
the same.
Kind of the same thing, but correct. It could also be a news event that you're saying, hey, look, this is not what I signed up for. But using stops doesn't increase the chances that your next trade will be right. Everybody says, well, I'll get out and then I'll go back into something else. Like I get a fresh slate. And again, what I tell people, what makes you think it's going to be any better the next time? If it didn't work this time, why do you think the stop's going to help you next time? They just keep
Maybe
doing
it
the
was your
same thing.
strategy that was wrong.
Exactly. Yeah, just a bad trade. But the stop doesn't change that. It doesn't give you an increased probability. I wish it did, because man, if you got stopped out 5 times in a row, now you could probably bet the farm on the next one because you've got virtually 100% chance of being right. It's not the way that it works. Now, another thing to remember is don't manage risk in downturns. I love this one. Why? Because you're under high stress. You're going to make snap decisions. I got to do something. The market's down. What should I do, Stu? Should I buy a put or should I buy two? Hurry, tell me something. I got to do something. Again, that's that goalkeeper bias. And when you're
Or
under
should I
high
or should
stress,
I sell or should I sell a call on my buy rate and then have the potential to lock in a loss? Oh,
it,
wait, how does that happen?
exactly, right? So that's the problem with during COVID or during the tariff tantrums and stuff to say, I got to do something. Not always. At least consider doing nothing. And so again, you're going to feel forced to do something. That's the goalkeeper bias. You're going to buy options during high volatility, which I mentioned before. It was at what, 55? I think it went up to 85, didn't it, during COVID?
Yeah, yeah, it was up in the 80s. Yeah,
85 or 90?
yeah.
I mean, outrageous volatility. You actually have to be careful around 30, 35, 55. No, thank you. 85, no chance. And then the problem is people say, well, let me sell options. Possibly, but then you get that big V bottom, and then you sold calls against it. And now you missed all of the upside.
Oh, but
So
that's okay because I made some money.
yeah, exactly.
We hear that a lot too. Oh, but you're not really thinking about the opportunity
Yeah.
costs that you invoked on yourself.
Yep. So
It's
if your
your
trading
you really
decisions
big.
are forced by losses, you're not going to be successful. All right. So you have to risk is managed before things get bad, and that's one of the reasons that we love
Up front. We keep harping
upfront things
up
like
front
stock replacement.
before you hit the send button.
Exactly. So here's one that we actually just did this recently here, didn't we? For one of our trading services.
CMG, yeah, we did.
So
Yeah,
here's CMG. Nice little, looks like a kicker pattern off the 1,000, which we talk about a lot.
love that.
All right. So now let's just say hypothetically that somebody wants to buy the stock and trading it around 43 bucks, 4,300 bucks for 100 shares. But,
Mhm.
and I just picked an arbitrary expiration, but we're at December here, 128 days.
Okay.
If we go out further, we might have to go a little deeper in the money, but the principle's the
Agreed.
same. This is called the
Yeah.
stock replacement strategy. So
Uh-huh.
look at this, a 35 call trading for 945. There's $1.29 of extrinsic value, which we can say is roughly maybe 70 cents of an insurance value,
Uh-huh.
and the rest is cost of carry. But now I've paid 945. What's my maximum loss, Stu?
945, my friend.
945. If I pay 43, can I say that 945 is my max loss?
Well, you
Nope.
could, but you'd be wrong.
Yeah, okay, fair enough. You could, but you'd be wrong. Could I use a stop? You could, but it doesn't
Good.
guarantee anything.
You could, but then when the stock turns and burns and goes to 65, you missed it.
Or when it does that, exactly. But now if we pay 945, that's an insurance policy. And people don't see it. They go, "Oh my gosh, I'm paying 945 for an option. I need to do let me go buy a put on top of it. Let me roll it. Let me do this." Why make it into a T-bill? The most you can lose is 945, and yet people say, "Well, that's completely unacceptable because that's a 100% loss."
Here's a
And
real here's how this can play out real quickly. So let's say that you have you say to yourself, well, I'm willing to look, I want to buy CMG. I really like their whatever slop it is that they sell in there. And I'm gonna buy their company. I'm gonna buy the stock. So now you go and you buy the stock and you say to yourself, I'm willing to lose 20%. I kind of made that number up.
yeah,
20%. And 20% is 43.5 times
860.
0.2, 860. Yeah, that wasn't really a mistake that I used that 20%. So, now it actually goes down by that amount, and then you stop yourself out, and then you're done, right?
Yeah.
I mean, you're out. Now, whatever happens in the future, whether it goes down more, you're out. Whether it turns and goes the other way, you're out as that as well. But all of the future activity, you're out.
You're
You just
out.
you're a non-participant. You're on the bleachers and you're looking down at the game. If you use an example like this one that Bill's showing you here, that money is, relatively, it's basically, maybe it was 21 or 22%. It's the same money.
Yeah.
It's the same money. And that same money can ride you
Yeah.
all the way through December.
Right. That stock could fall down here to 32 and a half to 30. You're still in.
Or 25
Or
or
25. You're
whatever.
still in. See,
Doesn't
that's
really
not
matter.
true up here with the stop order.
No, no.
But
And you can and that is tremendous,
yeah.
tremendous leverage. Why anybody would buy CMG common versus an option like this is
And
beyond
a
my
dividend is a possible exception, but this doesn't even pay a dividend.
doesn't pay a
So
dividend.
you're going and now again, if let's say that somebody says, that's a lot of extrinsic value, fine, come up here to 1170. $13.95, is that still better than 43?
I don't even know
Yeah,
how they would say that.
18.75, is that better? Right. Why were we even having the conversation? But here's the thing, one of the main points I wanted to make from this. Let's say that Stu bought the stock for 43.10 and he said, I want to get out if it goes down 10. And people say, "Oh, that's good. You picked that arbitrary line in the sand, and you've got your goals, and good for you." And I come in and I say, "I'm going to do it for 9.45. I'm going to get out if it falls to 9.45." Why? I don't know. I just picked that number. Oh, good for you. You've got that. You've already got that
Yeah,
uh,
you're a good risk manager.
pre-selected. You know that line in the sand.
Yeah, yeah.
Good for
You've
you.
done something.
You've done
You've done
something.
something. Yeah.
But however, if I say I paid 9.45
Uh-huh.
and I'm going to let it burn, they say that's completely unacceptable. You're a complete idiot because you lost 100%. You're like, people, it's 9.45 no matter how you cut it.
No
It's
matter how
just that
you
I'm
slice
making the maximum use of the insurance.
it. Right.
I'm letting that long-term bias and my potential outlook play out. And I'm giving it maximum time to do it. And I'm willing to lose 9.45, but people don't see it. And they always think that they have to
Yeah.
do something. Oh, I paid 9.45 for this option. It's now 5. And I know you get this all the time in coaching. What should I do? Is there a repair strategy? What do we tell people most of the time in Q&A? Has your outlook changed? No. Then just hold it. Yeah, but I'm down 50%. Who cares?
You're already hedged.
You're
That's
already
the
hedged.
line that people can't really or
Right.
don't,
They don't see it
you
as they
know,
see the put against long shares of stock as an insurance policy, but they don't realize
it's the
that a
same thing.
call is stock plus put. Mathematically, it's
Yeah,
the same thing.
same exact thing.
Yep, same thing. So again, we just thought that was a really good uh, and something very topical, where people just, they don't understand that doing nothing, again, it doesn't mean that has to always be the choice. It has to be in your list. So I mean, we even look at the calculations here. So you pay 9.45, the stock was 43.10. That's, let's call it roughly a fifth or about 5-to-1 leverage.
Hmm. It's
Who needs the
unbelievable.
dividends, right? Now, what we also do is we say that it's 35 strike plus the 9.45 price gives us an effective purchase price of 44.45, even though the stock is 43.10. So Stu and I will usually say I paid $1.35 over, because the numbers don't really matter. What we're saying, here's what I paid for the premium. Now, this is partly cost of carry, but it's also the insurance premium. But that's what we have to make up, regardless of where it's coming from. Well, again, you could say, well, I want to pay 99 cents over or
And by
74
the way, the
cents.
cost of carry is 55 cents. That's,
55 cents. Yeah, I mean,
theoretically, that should come
you're a
back to you.
cost of carry down here.
You're taking that money and you should be putting it, theoretically, at least you should be putting it in a money market that's paying 4.5%.
Yeah,
And
same
that's where you
same
get your 50
difference.
cents from.
Yep. So anyway, we hope that gives you, again, it's always about small things that make big differences. And we find that to be so true, especially in the world of options when we're dealing with timed assets and potentially a lot of leverage. So let's see if everybody learned some stuff here. Stu, you own 100 shares of ABC at 100, stock falls to 92. What would you do? Now, again, it was a little arbitrary. We wanted you to kind of make a list. But what my hope was, is you had a list, well, I would buy puts, I would close it, I would get back in, I would never let it fall to 92 because I would have a stop. But what we wanted to see is check your list. And did you have doing nothing? Was that one of your choices? And my guess is it's
Or
not.
buy it again.
Or if you want to use your scaling strategies,
Yeah.
absolutely. Yeah, it's not a good idea if you said up front, I'm willing to put X amount of dollars, and now I'm throwing good money after bad. But if your initial premise, I want to put whatever, $10,000, $50,000, and you're dividing it up over 5 or 6 trades, by all means, buy some more shares. Your average cost will be much closer to the market.
And by the way, if you do something like that, which is a really good idea, don't pay 100 and then 99 and then
Yeah,
90.
a 99.50. Well, I did buy it lower. Yeah, it didn't
Yeah,
do a
give
thing.
yourself some space, in between your
Let it
trades.
breathe. Right, we
Yeah,
can
let
let
it
it breathe to the downside, right?
let it
Yep,
breathe.
got to let it move. So anyway, we thought this was something very helpful, especially for a lot of the turbulent market, kind of always turbulent, but especially now. But just always remember that doing nothing is a choice. Remember that if you have an option, it is already hedged. It's already an insurance policy. And that's why Stu and I will typically let these things run a lot longer than other people will because we recognize it's already hedged. We already had
It's
that
part,
decided when we
yeah.
weren't under stress. And that example with Chipotle that we have 945, we already had that decided before anything happened that we're willing to lose 945. So
Yeah.
don't say, oh my gosh, something's happened. I now have to go do something. Why? Because that's the goalkeeper bias, and that is
And
most
look,
likely going to cost you money.
and that doesn't mean if we do lose 945 on that one, it doesn't mean that it doesn't hurt
Or
and
that
that
we can't,
we're
that
not
we don't
annoyed
make
by
up.
it,
Exactly.
but that's part of the game.
That is very good.
It's
It is
not
part of the game. You're going to miss
we
some shots.
we made a choice that we kind of like over time. We
Right.
like CMG. We have our reasons. We looked at the 1,000-day moving average and the price action, and kind of the shift in restaurant money, and all that kind of extraneous stuff. And we came up with the idea, right or wrong, that we kind of like the stock here.
Yeah.
And if the stock goes down, hey, we were wrong. It's not the
Right.
option's
Right.
fault, right?
What I
It's
can
not.
tell you for sure is if that option's trading for 7, you're not going to get an alert saying time to close. Guarantee you that.
No.
Unless they say, oh, Chipotle just got hit with closing stores for a code violation. We're saying, okay, well, this is not what we signed up for, but that's new information that we didn't have.
I don't know. I might be a buyer on that because the stock might be down 10%. And I
And
don't.
they might say we fix it. That's what makes it a
But the
market.
point is, like, we're not going to make a panic and rash
No,
decision.
no. So we just don't want to make sure that you're doing the same thing. So we hope that helps. And again, we look forward to many of you are going to be with us at noon Eastern time for Q&A part 2 on Thursday. And for the rest of you, we will see you next Thursday for Coach's Corner.
Yeah.